Welcome to Stocks in Translation, your essential conversation for cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. Today, I'm joined as always by Sydnee Fried, and also a blast from our past here, Sam Rowe. He is the founder and editor of theticker.co, and he's going to be talking to us about a bunch of stuff. But you were managing editor, of Yahoo Finance back in the day. Just a quick word for the audience.
Yeah, I was managing editor of Yahoo Finance from 2016 to 2021. It was a great time, great experience. I got to work with you very closely, and it looks like the exciting stuff continues here. This is great.
It does. We can. We're breaking in our brand new green screen here, so we're going to put some miles on it. On the docket today, we're going to channel our inner Vince Lombardi, and we're going to get back to fundamentals. In other words, earnings, sales, and the like, what investors should take away from these key quarterly numbers. And our phrase of the day, the bottom line, what it means for corporate profits as well as your portfolio. And this episode is brought to you by the number 24. That is the percentage of stocks that beat the S&P 500 this century. Just 1 in 4, I know. We're going to tell you why that's good and bad news for investors. Sam, Sydnee, first the story of the week. We're talking fundamentals here, and that would be revenue, net income, gross margins. Sam, this is your wheelhouse, and this is how you look at the market. Just kind of break that down for us and what you're seeing right now in the market.
Yeah, I mean, we always see what the price action is looking like, for the stock market, S&P 500, Dow, and the individual tickers. And, all of the fluctuations and stuff can be kind of nerve-wracking, especially when you see a huge run-up in price or a big drop or whatever. But, I don't think price alone is what, investors should be thinking about. Because at the end of the day, over time, over the long run at least, price seems to be driven by the fundamentals and most importantly, earnings. And so I guess that's what we're talking about today.
Yeah, and I just want to differentiate. You're talking about market prices, and prices of stocks are really the domain of technical analysis, and that's really what my specialty is. So fundamentals, I would say, can complement technical analysis, but I mean, how do you look at it?
For sure. I mean, yeah, they absolutely do complement, and I think you're right. I think in my experience, it seems that, technicals can define short-term moves much more than the fundamentals. If the fundamentals drove prices, then the markets would always be efficient. There'd be no opportunity to be had. But yeah, I think that's sort of the right balance.
So Sam, if you're kind of an early investor, I think it's clear you could easily look at a stock chart and say, this stock is up 50% this year, why not just invest? But you look at the fundamentals, that's what we're talking about. What's the most important fundamental we should be watching? Revenue,
expensive,
exactly.
Cheap, whatever.
Yeah, I mean, I think it all comes, it's the bottom line, right? And I think we were talking about this just a second ago. So, people throw around the phrase the bottom line all the time to get to the conclusion, to the main point. But the etymology, the story behind the bottom line is it's actually an accounting term, right? Back in the day when people used to have these big paper ledgers and write out their income statements, the top line is sales, the revenue, right? How much money comes in from actually selling a good.
Sales and revenue mean the same thing. There's a lot of stuff like that.
Yeah, it's a lot of stuff. Sales, revenue, top line, it's all the same thing. And then once you adjust that for the costs of those goods or services, you take out all the expenses, you take all the interest expenses from all the financing, you take out the taxes and other random things, then you have net income or earnings, or as they say in the accounting practice, it's the bottom line.
Yes.
So yeah, that's what it always gets back to, because at the end of the day, you start a business, you invest in a business. Sure, maybe philosophically you're out there to sell a really great product or service, but as an investor, it's about how much money you can actually make from that investment. And the money you take home is that bottom line, everything that after all of your costs and expenses.
Yeah, I think people have asked, so let me just back up a second. There are a couple different things that really drive the market. And one of those arguably is interest rates. And that's something I pay attention to the Fed. I think most people do. But it's really about earnings. And maybe just kind of break down the importance that if you don't have earnings growth, eventually you're just not going to see stock market returns. In other words, the stock price is not going to appreciate.
Sure, yeah, because the stock price is going to be sort of in one way or another related to where earnings are. So if earnings are going sideways, then you can't really expect the stock price to move up, and people will seek other kinds of investment opportunities.
Is there like a way in terms of a company's earnings? Oh, this company had beat earnings expectations 10 times in a row. That's a good company to invest in. Is there a hard and fast rule for something like that?
Yeah, I mean, I think that's really tricky because, when a company beats earnings expectations, that's as much a function of the analyst's ability to estimate earnings as it is the company's ability to beat those estimates or meet those estimates. I think, in the short run, there's probably something to extrapolate from that, both from, a company's ability to maneuver in the short term, as well as, how analysts, maybe you capture something about analyst sentiment, which might be a reflection of the market participants in there. But I think over the long run, it probably makes more sense to, strip all that stuff out and just look at what the actual reported earnings are and see what that looks like quarter over quarter and year over year over time and what's expected in the quarters and years to come.
Mm-hmm.
When we look at earnings, the various metrics can change by company according to their industry. For example, Walmart might be looking at gross merchandise volume, but all companies report sales. That's that top line. All companies report profit. And then you have adjusted, and then you start getting into all these different, variations on a theme here. Is it possible to get an apples to apples comparison, or is it just always going to be apples to oranges?
I think it's kind of always going to be apples to oranges. If there were one really great bulletproof accounting standard that everyone would be happy with, then there would never be adjusted earnings.
Bulletproof GAAP does not exist.
It does not exist. And it's actually something that, legendary investor Warren Buffett writes about almost every year in his annual letter. When he reports Berkshire Hathaway's quarterly earnings, they always report the GAAP, the generally accepted accounting principles, earnings and net income figure. But he also knows that that standard requires them to report these massive swings in their equity portfolio where, on paper, the value of the company and the value of their investments might be going up and down, but if they're never selling this, then it's actually not realized. So they have a lot of unrealized gains and unrealized losses in a given year. And so, you don't have to really worry about what all that stuff means. But the point of that is, Warren Buffett and Berkshire Hathaway, for instance, will make an adjustment for that. Mm-hmm. They remove all the noise that comes from stock price fluctuations and give you what they call an operating earnings number, which some people will call an adjusted number or the non-GAAP number. And the thinking behind that is by taking out some of these things that are noisy or unusual items, you get a better sense of the underlying health of a company.
But Sam, a lot of what you're saying I think must be really confusing for an early investor, someone who doesn't. New investors. Like a lot of these terms are similar, the GAAP, non-GAAP, the profit. Don't we say adjusted EPS and profit are like the same thing?
Yeah, and then on a per share basis, it creates all kinds of confusion there too.
So how do you cut through that language even when someone is trying to simplify something for you?
Yeah, I think that's the real question, Jared. Can you actually cut through? And it's like, there's a certain point where you can't simplify it anymore because at the end of the day, investing is complicated. If this was easy, then everyone would be doing it without thinking twice. And we'd probably be out of the job, right? Because
I know I would.
I definitely would too. Because if people understood this, I think there's a lot of people. There's an investing class that has a good grasp of this. But I think for us, people in the finance media industry where we are involved in education, we do have to try to figure out new ways to make this interesting and approachable. And, you also have to add this whole other layer of stuff like accounting standards are changing constantly.
Yes, that's another one.
Yeah. So
and accounting costs are always going up.
Right. And the accounting costs go up and then, it's like that's its own entire industry. I don't think there's really a great way to oversimplify or to simplify it in a way that's super intuitive. But I think a good starting point is to actually just, listen to what a company says about their earnings or their net income.
We see a lot of crosscurrents in the market, and this is a term that you've specifically used in some of your recent newsletters. What do you see as the crosscurrents right now? Because a lot of times in the market, seemingly always, one group of things is going this way, another group of things is going that way, and then maybe the market goes that way.
Sure. Yeah, I think there's a couple of different things that to juggle as someone who's following the market or following the economy and sort of the interplay between all those things. So one thing that's already kind of confusing is sort of the trajectory of the economy, right? Like for the last couple of years, we've had a pretty high pace of growth, fueled by a lot of spending, a lot of consumer spending, retail sales, industrial activity, people going back to work, the economy reopening, and GDP is accelerating and all this kind of stuff. More recently, it looks like growth has been decelerating, while stuff like retail, like all these things we just talked about, might still be growing. The rate at which they're growing is sort of cooling down a little bit. So I think that's like one of the bigger stories that we're sort of reading more and more about, is that the economy is slowing. Now, is that necessarily a bad thing? Sure, if you were positioned in a way, whether you're an investor or you are a manager at a company, if you're expecting a really high pace of growth and you invested for that, then yeah, maybe you're in some kind of trouble. But I think the important thing is that the economy continues to grow, and the businesses operating in that environment are continuing to see sales grow as well. So yeah, it's confusing, but yeah, we're going from a really great pace of growth to more decent, moderate pace of growth, and
And sometimes slower just seems like it's going in the reverse, but that's not actually the case.
Sure.
We need to pause right here just for a second. We're taking a short break, but coming up, we're going to break down a surprising finding about long-term stock holdings and another episode of Who Wore It Better. All right, we are back, and if you're keeping score here, we already went through our phrase of the day here, the bottom line. We've defined, actually Sam defined that for us in our opening segment here. So we are moving on to the episode. This episode is brought to you by the number 24. And you might be surprised to learn that only 24% of the stocks in the S&P 500 outperformed or had a higher return than the index itself. That's the S&P 500, which was up 390% over this period. That's 22 years. But Sam, only 1 in 4 stocks outperformed. That means 75% of them did not. If you're investing in the S&P 500, you're okay. But if you're stock picking, seems like you might miss the boat there.
Yeah, I mean, the odds are stacked against you if you're trying to pick winners in the stock market, or I guess more specifically, trying to find the stocks that are going to outperform the averages, outperform the index.
That's not what I want to hear. I want to hear that I can pick.
Yeah, I mean, I guess the easy sort of like, I guess there used to be this myth out there that you could flip a coin, or you can have monkeys throwing darts at a stock sheet, and because it's kind of 50-50, there was a decent chance you can find the stocks that are going to beat the market and help you become more rich than someone who's just invested in the S&P. But there's been a lot of really great studies that have been published in the last couple of years. The one you're talking about comes from S&P Dow Jones,
yes.
Actually, and what they did was they did a study of the S&P 500's return, as well as the individual components of the S&P. And yeah, it turns out that it's a small handful, or a quarter or maybe 20% of the stocks in the index actually outperform. And one of the reasons why this happens is because of asymmetrical returns, right? Or asymmetrical performance, right? A specific company can only fall by 100%, but on the way up, you could go up 100, 200, 300, 400, and it can go up for infinity. Mm-hmm. There was just a great Bloomberg article last week that was published that was talking about, since NVIDIA's IPO, NVIDIA is up 350,000%. Like, these are astronomical numbers to think about. But
5 10 baggers are embedded in there. That means 5 times it has experienced 1,000% returns over a relatively short period of time.
Right. So, like, unless you're smart enough or lucky enough to actually pick those right stocks, if you don't have those in your portfolio, then you're going to underperform, no matter how great of an investor or stock picker you are. So, the takeaway ends up being that, unless you're convinced that you can have some kind of advantage in this market, the move ends up becoming, buying the entire index, because you're also going to get exposure to those winners that are going to drive the entire market higher.
So what do we really mean by outperform? Like, obviously it means a stock does better than the whole of the index, but there's a lot of ways we say outperform.
Yeah.
We rate stocks outperform.
Yeah,
we rate
yeah.
them by, like, And then it's like once you're outperforming, aren't you just performing?
Sure,
or-
yeah. So that's one of the great. It's so confusing, like especially like when analysts on Wall Street rate stocks, because everyone has kind of a different convention. There's outperform and underperform. There's buy and sell, and some places will actually say overweight and underweight as their way of communicating. So there's sort of like two categories of this. There are the absolute ratings and the relative price ratings. So absolute meaning, is the price going to go up or down? So this is where you have company or firms that say, you either buy, hold, or sell a stock because they think it's either going to go up, nowhere, or down. Outperform or underperform is a way of communicating that they think that a stock that's going to outperform is going to do better than average. A stock that's going to underperform is going to do worse than average. So in this universe, it's actually possible for a stock to be going up, but if it's going up at a below average pace, it's underperforming. It might sound bad, but you could still be making money on this.
It sounds confusing, but I do kind of like it. But S&P 500, people have price targets, but they don't have the buy. I mean, that would be weird, right? You can't buy the S&P on its own. So buy, outperform, like no one's doing that exactly.
I mean, you can certainly, I mean, it's, some people do, some people don't. It is a popular practice for various Wall Street firms to have a target for the S&P 500 as an index. And through that, they're communicating whether you should be buying or selling. But, I think something that, you learn over time after paying attention to this for a little while is that a lot of times those price targets are are off.
Oh, yeah.
Yeah. And
well, sometimes it looks like somebody just chose those with a dart. I mean, there's a whole game to analyst ratings in and of itself. But you're always trying to guess what this company is doing in its own, behind the doors black box model. So it is difficult to divine what's going on.
Sure. And it's not, and the confusion actually ends up going both ways, right? Even if you do have a pretty great grasp of what a company is doing and what that business is doing, and you come up with a number that may or may not be in line with what that company's management is thinking, well, if your target for earnings, for instance, is not in line with management's internal targets for earnings or what they're on pace to do, then the companies themselves might feel under pressure to, maybe move some things around in their business to meet what the analysts are suggesting this company should earn. So yeah, it's a really fraught game that we play every quarter where, did this company actually meet or miss expectations, or are they, pulling some tricks to, beat or miss those expectations? Yeah, and what are the analysts doing too? It's like, is this a matter of them, trying to actually be accurate, or are they trying to come up with numbers that might be a little bit below the averages so that the company?
Or do they just want to get headlines? I mean, we see everything.
Of course, yeah.
All right, we're gonna leave that for a second, and we want to make time now for Who Wore It Better, where we stack two things or ideas next to each other to come to a non-binding opinion about who's wearing it better. And Sam, today we're looking at two different Warren Buffett quotes, and we want your opinion about which one delivers a better, more useful message to investors. And both concern prices, by the way. Quote number one, Warren Buffett: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Number two, price is what you pay, value is what you get. So two different ways of looking at it there.
I feel like they kind of mean the same thing. So I'm going to go with the second one because it's a little bit more straightforward. Price is what you pay, that's very intuitive, and value is what you get. It's like buying a cup of coffee at Starbucks or whatever, right? You pay $8 to get a venti coffee, and that's the actual transaction, but maybe you get $15 worth of joy out of it, and so that's the value, right?
The psychic gains of that amaretto mocha.
Exactly.
Yeah, I mean, like if my mother goes to Starbucks and pays $8 for that coffee, she's getting $4 worth of value out of it. So it's a completely different, the nature of that
That's why she's
transaction.
not there in the first place, probably.
Exactly, yeah. So I do like that quote because it makes you think about the difference between, one type of dollar sign versus another.
Price is what you pay, value is what you get. We got some time left. I want to talk to you about your personal journey here. You left Yahoo Finance, I believe, in 2021. Correct me if I'm wrong, but you started the ticker. This is your own newsletter. This is your baby. You put your heart and soul into it. Just tell us why you started it and what you wanted to give to investors.
Yeah, I mean, the simple thing is it was based off of a lot of feedback that I felt like I was getting from readers over the years throughout my career of doing this for about 15 or 16 years, where I think there are. The big audiences are made up of lots of different small audiences, right? And I think that I had some kind of a following, or I was getting feedback from people who liked a certain kind of storytelling or liked a certain kind of coverage that they were getting at places like Yahoo Finance or whatever. And so it's for an audience that's a little bit more longer term thinking, that might not be as active in their investments as someone who might be like a retail trader or someone who does, follow the markets every day. I write for an audience that I think that's pretty much it. Longer term thinkings, people who do see headlines every day, but they want to know what those headlines mean in the context of them planning for retirement in 20 years. The same story or the same development in corporate America or the economy will mean different things depending on your time horizon. And so for my audience, it's mostly about people trying to understand what things mean in the long run.
And that's hard because it's hard to, we talked about this earlier, it's hard to digest all these different languages that make up the stock market, right?
For sure.
So what would you say your audience, I don't know if you have this information, kind of struggles to understand about the markets or about their portfolio?
I mean, I think it's less about the understanding and more about sort of separating material news versus the noise. And not to say that there's any kind of news that isn't newsworthy, but there might be news and there might be developments that might not be material for someone who's thinking in the long run. Kind of like what we were talking about earlier about, whether or not a company beats or misses earnings estimates, right? That might tell us something about the market action in a given day or a week or a couple of months. But behind that, you have this net income number, the bottom line, right? The word of the day.
Yeah, there's a lot that we're not seeing.
Yeah, there's a lot we're not seeing, and it can be pretty, depending on the audience, it can be pretty distracting to see a headline that's, this company beat or missed expectations. Whereas it might actually be the case that a company that's missing expectations is still delivering earnings growth and still continues to plan to deliver earnings growth. So, that's the other side of it. Like I try to approach things with a certain kind of framing with that sort of audience in mind.
Yeah, go ahead.
I was just going to say, and what do you think, like in your own financial journey, what do you think has been the hardest thing to understand?
I think the hardest thing to understand was actually what we were just talking about. This idea
we covered it. Great.
Yeah, we covered it. But the idea that picking stocks is like a coin toss, when in fact, picking winning stocks is, the odds are stacked against you. Unless you have some unique skill, and which, by the way, there's an entire industry of people who get paid tons of money to try to figure out what these winners are, and almost all of them underperform and pick the wrong stocks.
That's right. The hedge fund managers are not doing a great job themselves by and large.
Exactly. So I think that's what took me the longest to sort of understand, at least for myself in terms of my own investment philosophy, is that, it's very difficult to beat these indexes. So you just...
What I love about the ticker, you're always coming from an honest place, trying to break things down for people. You ask the questions that are always in the back of my mind, but don't seem to get addressed. My only paid sub. I get nothing out of this, but you're one of the greats here. So continued success at the ticker, and we are winding things down. 24 minutes goes pretty shortly here, but thank you, Sam, once again, and Sydnee as well. Keep it locked to Yahoo Finance.